This week, political gridlock in DC slammed right into a massive wave of corporate AI spending. Let's break down the day-by-day of what moved price and why. So, you had this real tug-of-war playing out. On one side, you've got political paralysis, the shutdown, the Fed keeping everyone guessing. And on the other, a straight-up fire hose of cash being spent on AI infrastructure. Let's dig into the numbers.
All right, let's start with the weekly snapshot.
So definitely a risk-off week across the board. The S&P 500 closed at 6850. That's down 1.2%. The NASDAQ 100 down 1.8%, and the Russell 2000 really led the way down, dropping 2.5%. Now look at rates. The 10-year yield popped 15 basis points to 4.10%, mostly on that Fed uncertainty. And you saw a flight to safety with the dollar index climbing 0.5%. WTI crude, though, got hit, dropping 3% to $57 a barrel. Okay, let's walk through the tape day by day. So, the week kicked off on Monday with the government shutdown hitting day 35. We're talking real economic damage here. The CBO was already estimating it in the tens of billions. Then on Tuesday, Fed Chair Powell throws some cold water on the market, saying a December rate cut was, and I quote, not a done deal. That sent the 10-year yield right up to its weekly high. But then Wednesday, boom, a totally different story. Microsoft and Amazon dropped news of massive, multi-billion-dollar AI deals, giving the market a completely different narrative to chew on. That optimism didn't last long, though. Thursday's Challenger report was ugly, the highest number of job cuts in 20 years, a huge red flag for the labor market. And all of that led into Friday, where the session closed with really poor market breadth, a classic sign that the headline index isn't telling the whole story. So let's zoom out and look at the dominant themes that were really driving the action. Right, so this was the core conflict all week. On one hand, you had these major political and macro headwinds, the shutdown dragging on, the Fed being hawkish, and then that awful jobs data. But pulling in the other direction were some serious corporate tailwinds. I mean, we're talking a historic wave of AI-driven capital spending and a boom in data centers. This created a really choppy, divergent market, where you had to be watching specific sectors, not just the broad index. And you can see the net effect of all this uncertainty right in the VIX. It climbed from 16 to 18. So even with all that great corporate news, the political mess in Washington was enough to elevate fear and make a portfolio protection, insurance, more expensive. Now, if you look under the hood at positioning, it tells a really interesting story. Sentiment climbed out of extreme fear, but it just couldn't get past neutral. At the same time, you've got major players like Berkshire sitting on record levels of cash. That's a ton of dry powder on the sidelines. And get this, we saw some really unusual options activity in Amazon and Kimberly-Clark right before their big deals were announced. Somebody knew something. And just a quick reminder here, options trading carries substantial risk and you can lose your entire premium. All right, let's drill down into the specific sectors and stocks that were on the move. The market was really split in two this week. The money was chasing the story. It flowed into anything with a clear tailwind. Think AI, data centers, biotech, and defense. And it fled from anything with a headwind, so financials, consumer staples, and retail. All of them got hit hard, caught between rate uncertainty and the direct impacts of the shutdown.
Specifically, money poured into the picks and shovels plays. Companies like Supermicro and Vertiv, the ones actually building the AI infrastructure, they saw real strength. On the flip side, you could see the pain in the ETFs. XLF for financials, XLP for staples, XRT for retail, all showed clear weakness. And then you have the direct victims of the shutdown. Companies that rely on SNAP benefits took a hit, and airlines were a mess with all the operational disruptions.
A really interesting puzzle this week was Palantir. The company puts up a strong earnings report, and the stock sells off. So what does that tell you? Is it just a sign of a weak tape overall? Or are investors starting to get nervous about that high valuation, even when the company is executing well? That's the big question. Okay, let's talk levels. Section 5, Key Technicals. All right, some major levels were in play this week. For the S&P, that critical long-term support at 668 was the absolute battleground. Over on the NASDAQ 100, the key was the 600 level. You had a nice confluence there of the 50-day moving average and a big dark pool print holding things up. But honestly, the most important technical signal for me was the breadth. It just kept getting worse. The advanced decline line was diverging from price, and that is a classic warning sign that a rally doesn't have legs. And speaking of warning signs, a cluster of Hindenburg omen signals popped up this week. Now, for those who don't know, this is basically a technical alarm that goes off when you have a really terrible market breadth, like we just talked about, happening while the main index is still hanging out near its highs. It's not a perfect predictor by any means, but historically, seeing a cluster of these signals has been a heads up for potential instability ahead.
All right, let's look ahead. What's on the calendar for next week? So on Monday, the focus is squarely on DC. Any news on the shutdown negotiations is going to move the market. Then Wednesday at 8:15 a.m. Eastern, we get the ADP private payrolls report. After that weak challenger number last week, this will be a really crucial data point on the health of the labor market. And we close out the week on Friday at 10 a.m. with the University of Michigan Consumer Sentiment Report. This will give us a fresh read on how the consumer is feeling and, just as importantly, what their inflation expectations are.
Just a reminder, this content is for educational purposes only. It aggregates public sources to help you stay informed and improve your own decision-making. You must do your own research. This is not financial advice. And hey, if you found this recap helpful, do us a favor and hit that like and subscribe button. It really does help signal the algorithm and gets this out to more people. We appreciate your support. And one last time, this is not trading advice, it's just a market recap. Markets carry risk, always manage your downside, and verify all the data yourself.